Good morning, good afternoon, and good evening, real estate investors. Here are 5 key stories today about distressed real estate in the U.S., highlighting recent trends in the news. These stories focus on major events, market shifts, and notable cases based on the latest information, especially from recent news sources. 1. The surge in multifamily distress in the Lone Star State. In Texas, especially Dallas, Houston, and San Antonio, over $400 million worth of distressed multifamily properties are headed to auction. High-profile defaults from firms like S2 Capital and Tides Equities have attracted attention. This highlights broader challenges in the sector where rapid price increases during the pandemic have strained investors, worsened by rising interest rates and cooling demand. Texas is becoming a hot spot for distressed real estate in 2025. 2. The continued struggles of office space in Southern California. Southern California's office market, particularly in Los Angeles and Orange County, is facing big trouble. Valuations are being slashed, deals are being discounted heavily, and foreclosures are on the rise as the sector recovers from pandemic hits. Many offices sit underused due to remote work, with some properties selling at 50-60% of their previous values. Tenants are now favoring premium spaces, leaving older or less desirable offices vulnerable. 3. Banks facing massive commercial real estate debt maturities and defaults. Almost $1.8 trillion in commercial real estate loans will mature by the end of 2026, a so-called maturity wall that could trigger more distress. With interest rates soaring from under 4% to over 7%, refinancing has become tougher, and new payments could be 75 to 100% higher. Lenders are extending loans to delay defaults, but regulatory limits and capital shortages could force sales or foreclosures. The office and multifamily sectors are most at risk, with over $67 billion in distressed assets. 4. The rising increase in foreclosures and REO properties. Foreclosure activity nationwide is growing. In May 2025, there were over 24,000 foreclosure starts, up 8% from last year. Real estate-owned REO properties, homes repossessed after failed auctions, spiked 34%. Markets like Florida and Texas are seeing more REOs, raising concerns that lenders are trying to clear a backlog or that deeper issues are emerging in both residential and commercial markets. 5. The increased risk of regional bank failures. Industry leaders like Barry Sternlicht and Howard Lutnick warn that 500 to 1,000 regional banks could fail in 2025 or 2026 due to stress in commercial real estate, especially the office sector. These banks are major lenders to the real estate market, but declining property values and rising rates put pressure on them. Mergers or FDIC interventions might happen, which could reshape real estate financing, affecting small landlords and investors. These stories reveal the ongoing challenges caused by high interest rates, post-pandemic shifts, and regional differences. Texas and California are particularly notable areas for trouble. But one thing is for certain, with this much distress, the banks are starting to loosen their grip on their distressed debt and can lead to some huge opportunities for distressed debt buyers. Want to find out how you can capitalize on this? Book a call with me at talkwithscottcarson.com and find out how you can become a note buyer today.